Good day, legends. Tax time can be a real head-scratcher, especially if you're investing in ETFs. Today, I'm breaking down everything Aussie investors need to know about ETF tax reporting, franking credits, and distributions using easy numbers and, of course, simple animations. Let's make tax less taxing. First up, how are ETFs taxed in Australia? ETFs don't pay tax themselves, they pass income straight through to you, the investor. That means you're on the hook for tax on any income, franking credits, and capital gains your ETF distributes. Your ETF income usually falls into three buckets: dividends, paid from Aussie shares, often with franking credits; interest, if your ETF holds bonds or cash; capital gains, if the ETF sells assets for a profit, or when you sell your ETF units. Let's talk about franking credits. These are a classic Aussie tax perk. When an Aussie company pays tax on its profits, it attaches franking credits to dividends. ETFs pass those credits to you. You can use franking credits to offset your own tax bill, so you're not taxed twice on the same money. Example, say your ETF pays you a $70 dividend with $30 in franking credits. You declare $100 as income, but you get a $30 tax credit to reduce your tax bill. Here's a common trap: the cash you receive isn't always the same as your taxable income. Thanks to the AMIT rules, your ETF might attribute $100 of income to you, but only pay you $90 in cash. You still have to declare the full $100 on your tax return. Why the difference? Under the Attribution Managed Investment Trust (AMIT) regime, ETFs can attribute income you haven't received in cash. The good news: if you're taxed on more than you receive, your ETF's cost base is increased by the difference. This helps avoid double taxation when you eventually sell your ETF units. Example, if you are attributed $100 but only get $90, your cost base goes up by $10. When you sell, you'll pay less capital gains tax. When you sell your ETF units, you may trigger capital gains tax. If you've held the ETF for more than 12 months, you get a 50% CGT discount. Example, bought 100 units for $1,000, sold for $1,500 after 2 years. Gain equals $500. With the discount, only $250 is taxable. After June 30th, your ETF provider will send you a tax statement, often called an AMMA or annual member statement. It breaks down all the income, franking credits, capital gains, and cost base adjustments you need for your tax return. Use your ETF tax statement to fill in your tax return. The statement will show you exactly which numbers go in which boxes, like franked distributions, franking credits, foreign income, and capital gains. If you invest in international ETFs, you might see foreign income and foreign tax withheld. You'll need to report this as foreign income, and you may be able to claim a foreign income tax offset to avoid double taxation. Watch out for these mistakes. Relying only on broker reports, always use your ETF's official tax statement. Forgetting to update your cost base each year. Missing out on franking credits or foreign tax offsets. Keep all your ETF tax statements and records. Update your cost base every year, especially if you reinvest distributions or have AMIT adjustments. It'll save you a headache when you sell. To wrap up, ETFs pass through income and credits, you pay the tax. Franking credits can reduce your tax bill. Always use your ETF's tax statement for your return. Update your cost base each year. Hold for 12+ months for CGT discount. Seek advice if you're unsure. This video is for education only, not tax advice. For personal help, see a registered tax agent. If you found this helpful, smash like, subscribe, and drop your ETF tax questions in the comments.